Texas Lutheran University.
It is truly wonderful to have all of you here on homecoming weekend at Texas Lutheran University. Today's speaker is Wally Weitz. He was born and raised in New Orleans, and by the age of 12, the investing bug had bit him. He started trying to learn as much as he possibly could about investing, and subsequently, upon graduation from high school, ended up at Carleton College in Northfield, Minnesota. While he was there, two transformative things happened. Number one, he met his wife, which is always a good sign. Number two, in pursuit of his BA in economics degree, he also figured out who a guy named Ben Graham was. And Ben Graham is the father of value investing. So if you want to know where Warren Buffett got all the knowledge that he has accumulated today, it started with Ben Graham. So while Wally was in college, he started reading Ben Graham's books, the security analysis and all the other great things that he had put together. And that helped him to land a job in New York as a financial analyst, living there, got married, decided that New York was not exactly where they wanted to make their home. Well, Wally's wife, Barbara, is from Omaha, and so they decided that that is where home would be. Well, a funny thing happened along the way. Somebody tapped Wally on the shoulder and said, "Hey, by the way, I hear you're moving to Omaha. If you're going to be out there, there's this guy you should meet." Maybe you've heard of him. His name's Warren Buffett. And this was 1970, 73, something like that. So Warren Buffett was not the household name, was not the second or third wealthiest person in the world at the time. But Wally sought out Buffett's wisdom, and the two of them have been friends, and Wally continues to consider Warren Buffett to be a true mentor, something that all of us should strive for. So in living in Omaha, he worked for an investment firm called Childs Hyder. And he started out as an analyst and eventually built up to be a portfolio manager. And then for some reason, I don't know if he fell down and hit his head, but he decided to take that fateful step and become an entrepreneur. So in 1983, he stepped out to start his own firm with the backing of a few clients out of about $11 million worth of money. He said, "I'm going to go do my own thing." And he was telling me today at lunch that he sat down, met with Warren Buffett, said, "You know, this is what I'm thinking of doing." Buffett asked him 4 questions, and they were so insightful that by the time they had even finished with the 4 questions, Wally knew it was the right thing to do. Well, fast forward 32 years. Today, Weitz Investments manages about $4 or $5 billion, depending on the day and how happy or upset the market is. The firm manages, or employs, 37, 38 people? Somewhere thereabouts. One of which is his son, Andrew. And if you go back and you look at their track record, compare it to the S&P 500, they've done a fantastic job of outperforming the market over very long cycles, something that a lot of people say cannot be done anymore. He does enjoy his free time. He reads, golfs, and likes to work. And a lot like Warren Buffett says that he'll probably retire the week after he dies. I've been around Wally a couple times over the last 2 or 3 years, and I have observed that he does not necessarily seek the spotlight. He is far more comfortable probably sitting in a corner just observing everything that goes on. And one thing I know about people who have that type of behavior is that they may not speak often, but when they do speak, you should really listen. So with that, please help me welcome Wally Weitz.
Thank you. That's with that build-up, I'm scared now. Sound okay there in the back? Okay. Got a few slides here that collected just for starters, but I'd much rather do Q&A. So I'm going to try to go fast through here. There's maybe a few concepts that'd be useful for the conversation. One footnote I should give to the introduction is I did stumble onto Ben Graham at Carleton, but it was on my own, and when I tried to get independent study credit for doing what I was going to do anyway. They saw through that. And also, Carleton College in the 60s had no interest in the stock market or anything practical. I think a small liberal arts school is exactly the right kind of school. But you guys have, I guess, have a little business twist that you can study here. We didn't have that at Carleton. Anyway, this is our, we are 38 or 9 or something. We've hired a few people lately. This is most of them. It's not a current picture. It's probably 6 months old. There might be 1 or 2 new people, but being value guys, we don't redo the pictures every time we hire somebody. And the same is true here. This is our investment team. We are now 12. This is 11. Some year we'll put Dan in the picture. Here's one of our original funds is the Gray Mountain, and the colored lines are the S&P and some other index, Russell 3000. I put that up there not to show the record so much as this is a slide I use a lot of times with investment advisors. And the caption at the top is about value investing works, but only if clients allow it to work. And this is, you've probably studied the difference between time-weighted returns, which is the gray bar, and dollar-weighted returns. And people who put their money in after something did well and then get disappointed and take it out at the bottom and then put it back in after it recovers end up with a lot lower real rate of return. There's studies that show that stocks have made 10% a year forever, stock funds make 9% a year, difference being expenses, but that stock fund investors make something like 3% a year. And it's because they shoot themselves in the foot. So this is my dig at financial advisors when I talk to them. This is an illustration of kind of the way we approach value investing. And I think the textbooks you may read that value investors look for low PE or low price to book or something statistically cheap. And if you buy a lot of cheap things, you'll mostly stay out of trouble and you'll have positive returns. And that's okay as far as it goes. But our approach to cheapness is not just a statistical measure. It's what a business would be worth if an intelligent buyer were going to buy the whole thing. And so if a person's going to buy into a business, going to own it indefinitely, what he cares about is how much cash you'll be able to pull out of the business over the years. And so if you've done discounted cash flow models, what you do is you estimate how much cash will be available to the owners each year going out into the future. You discount it back at some discount rate. We happen to use 12, which is pretty high. But it's definitely art, not science. You got to be very careful because every one of those estimates is going to be wrong, but you want to be approximately right. And so what we get with the red line is what we think on this day in whatever that says. I can't read the number. Whatever year this was, we thought that Liberty Global was worth 19 or something. And then each quarter, as we get new data, new earnings, redo the models, we come up with a new number each time. And ideally, you would like to have your company grow in value over time. The green line is 70% of the red line. It's a 30% discount. We want to buy something that's measurable, that's growing, but we want to buy it at less than it's worth. That's Ben Graham's margin of safety. So the green line, we'd love to buy it at 70 cents on the dollar or 60 or 50 if possible. And so the green line is just the 70% line. The blue line is the stock price. And in the case of Liberty, we actually owned it back here, but we hadn't started, we didn't have the data for this chart, but we have owned it all the way through, but tried to buy more when it was down by the green line. And the perfect, from my point of view, the perfect experience is that the value keeps growing forever and the stock price doesn't quite get there, so you don't have to sell it. Because if it gets to be 100 cents on the dollar or more, then the margin of safety's gone and we feel like we need to get out. And it's much better if you can hold something for a long time, avoid the transaction costs, the taxes, and so on. Another one that didn't just go straight up. I didn't put only stocks that worked great in here, although this one's been fine. This is Martin Marietta Materials. It's rocks and gravel. It is not a sexy company. It does better when people are building highways and building buildings. And again, the value actually went down as we got into the recession, not because anything happened to the rocks and gravel in the ground, just that the cash we expected to get by selling that was further out in the future. So if we were going to not get it for 5 years instead of 2 years, it's worth less today. And so we were able to buy Martin at various times through this period of several years, even though the actual value has only come back to where it was back in the 2008. By buying the stock only being cheap about when we bought it, we were able to still have quite a bit of it when it came up and actually went through the value. So now we're out of this stock. We're going to keep following it. Nathan Ritz will still go out to the quarries, and he likes to climb around in mines and things. But we want to keep track of where that red line goes, so that we'd love to own it again, but not unless it's cheap enough. And one more, Berkshire Hathaway. I think everybody knows about Warren, but the same idea works in dealing with Berkshire Hathaway. At times, it's expensive relative. The stock is expensive relative to its underlying business value, and other times it's really cheap. So we've been continuous holders of Berkshire since 1976, so that's going on 40 years now, as even before the company started. But in much different size positions. When it gets really expensive, I can't bear to let loose of the last few shares, but we take it down to very low level. And in other times, like the bottom in 2008, I think that's 2008, when it got down to 70,000 a share, we took the position up to 13 or 14%, which is, for us, a full position is about 5%. So it was double plus, because in a recession, the world seemed to be coming to an end. We were pretty sure it wasn't, but weren't positive. And having Warren there with excess cash flow to generate and the ability to be, I wouldn't want to say loan shark, but the ability to help out other companies in financial distress like Goldman Sachs and Bank of America really adds to the value of the business. So that was another one. We do this for every one of our companies. We have pretty concentrated portfolios. The top 10 positions are usually 40 to 50% of the portfolio. We might have a total of 30 or 35. But we have another 50 or 75 companies that we're following closely enough that we have valuations figured, and we call it our on-deck list, and we hope to be able to buy them at 70, 60, 50 cents on the dollar. The other point I'd make before wrapping up is that management is awfully important. I've been doing this now since 1970, and I'm more convinced than ever that unless you think your manager, they don't have to be brilliant, but they sure need to be honest, and they need to be flexible. They need to be honest with themselves, so when things are going wrong, that they recognize it and do something about it. Able to reinvent the company if necessary. If newspapers are over, you need to be able to go into other things like cable TV, and that's what Washington Post has done. But John Malone is, if you don't know of him, he's the guy who founded Liberty Media, and there's now probably a dozen companies that at one time or another were part of Liberty Media. We own about 6 of them right now. And Buffett and 2 other Liberty managers. This is That's Mike Freeze down there in the lower left. He runs Liberty Global, which was the first chart I put up. He also plays in a rock band. They do charity concerts. Actually, the original title on this slide I used in a different time was "One of These Is Not Like the Others." Tribute to Sesame Street, but they are alike in the fact that when you go into a really tough time like 08, 09, you don't know what they're going to do exactly, but you can trust that it's going to be good for shareholders, and that's very comforting when all else is up for grabs. There's another slide with some more those. I won't dwell on this, but it's the chart of over the last several years when the Fed has done all sorts of different maneuvers, QE1, QE2, Operation Twist. And this was just making the point that the market seems to go up while they're doing it in the colored sections and go back down when they stop doing whatever they're doing. And it's sort of like feeding a drug to an addict, and it seems to be having less and less impact. And it seems very plausible that extra $4 trillion that the Fed has pumped into the market has gotten stock prices ahead of themselves. And that doesn't mean we have to have a disaster, but it could well mean that stocks trade down another 10 or 20, 25%. It would be great as far as I'm concerned, because we have a lot of dry powder in our funds. We'd much rather have cheap stocks to buy than overvalued ones. That's about guessing the future. Can't do it. This is one of my favorites. This is the last 10 years of financial engineering by John Malone of the various Liberty entities. We won't go into detail there, but he has been very creative and imaginative about taking great raw material, mostly media companies of different kinds, raw material that generates free cash flow, and using mergers, using tracking stocks, using spin-offs to get the full value to the shareholders. Okay, enough of slides. I'd rather hear your questions. We can talk about how the business works. We can talk about investment valuation things. We can talk about whatever you want.
Guys, start firing away.
Yeah.
I was curious, you said that you're expecting the market to maybe go down 10, 20%. How much cash do you keep in your portfolio? Is there like a minimum you like to carry?
The formal answer is we don't target cash levels and we don't try to predict the stock market. All we do is buy things when they're cheap, sell them when they're expensive, and if we can't find a replacement for the expensive one we sold, we let the proceeds pile up. As a practical matter, we rarely get below about 10%. I just like having cash around because stuff happens. We have been as high as 30 or 35% in the conventional stock funds. We're about high teens or 20% right now, but it's not based on a prediction of stocks going down. It's based on valuation levels. They're just not, things aren't cheap enough to want to be aggressively buying. Now, then you sort of reverse engineer an explanation to yourself of why that might be or where you might be wrong. And I come up with, the Fed's fire hose having maybe inflated everything, and maybe when they stop doing that, the levitation will be over. Now, it could be that stock prices stay right where they are and the values grow into them, or they could just keep on going some more, in which case we'll be left behind some more. But we have a 30-plus year record of beating the S&P by 2.5 percentage points after fees, which, puts us, well, just keeping at it 30 years puts us in rare company. But the record's good, but it just doesn't happen year by year by year. And I think we've underperformed, that graph that got to a high place relative to the market is like 1,000 or 2,000% cumulative advantage, but we probably underperformed 1 year out of 3 or something like, I haven't counted, but about a third of the time. And so people who get disappointed with that and sell and go on to the next thing that did well last year gives you the problem that I pointed to in the very beginning. Yeah.
What are the factors that go into creating your red line?
Okay, the factors that we use in valuing the business, the theory, as I say, is making estimates of the future cash flows, discounting them back, adding it up. It varies by company, because we know that, with a cable business, for example, it's a subscription business, and you get a few more subscribers, it's pretty easy to model what the cash flows might be. You make a guess about programming costs and that sort of thing. Other things like Martin Marietta, you are definitely guessing about the pattern of cash flows, and so you're probably a little more demanding or a little more conservative about the estimates of those. But in each case, you're making just a model of how the business works, what the big chunks on the income statement, and what they're likely to look like. With excess cash, we have to make some guesses about some companies are very likely to buy in a lot of stocks, so increase the per share amount by shrinking the market cap. Others are very acquisitive and likely to make new acquisitions, and we might have to make guesses about that. So one of the managers up there was Nick Howley from TransDigm, and that's a company that buys several times a year. They'll make an acquisition of an airplane parts maker, some company that makes seat belts or nuts or bolts, or preferably that are sole suppliers to Boeing or to one of the manufacturers, or at most maybe a second, one of two suppliers. And their pattern is they are great at getting manufacturing costs down. They're great at having a little more nerve about raising prices than maybe the little mom and pop shop that they bought it from. So they take on more leverage than the little guy would be comfortable with to make the acquisition, lower the cost, raise the profitability, pay back the debt, and then do it again. And they just do it over and over and over again. But you never know if we're in a recession and people start canceling orders at Airbus and Boeing. It could be that they're doing mostly replacement parts, but if the number of hours flown goes down, the pattern may be wrong. But so and that's why the line changes at least every quarter, because we're reassessing. But it's their market position, how cyclical it is, whether their balance sheet is going to get them in trouble or not, how acquisitive they're going to be, how good they are at capital allocation. Because a lot of companies buy back a lot of stock, but they buy it at high prices, and then they stop when the market goes down. And it's exactly, we want to try to avoid those. And when we look at an energy company, for example, you guys are probably more well acquainted with the oil and gas industry than I am. But I've seen, in my 35 years, I've seen several boom and bust periods, and there's no way that we can know what the price is going to be 10 years from now of oil or gas. But in that case, we might go with reserves in the ground as a bottom, as a base case, that even at X dollars, they have at least this much, or they have hedges on for the next 2 or 3 years. But want a much deeper discount when we buy something because there's a lot less certainty from that red line. But it's the valuing of the business is really, it's art, but there's no magic about it. And you know that you need to be continually adjusting because a lot of things change. But what we love to see is the red line growing, the top, the business value growing, but some sort of temporary factors that are holding investors back. And I mean, you can't imagine how many times I've stood around in a group of experts and analysts on the cable industry or the telecom industry, and some expert will make the statement that, well, the stock's worth twice as much as it's selling for, but don't buy it now because the next quarter's kind of, probably going to be kind of soft. And I just love to hear that, because why, then you go ahead and buy it, and maybe it will be soft, and then you buy some more. But people are so short-term oriented that when it really comes down to it, it's not like we're the only ones that can figure out that business value, but the people, fear and greed drive people to sell things at the bottom, buy them at the top, and we're trying to take the other side of that emotional mistake. It's not about science. It's not even almost about business. It's about a game with players that are making mistakes that are unnecessary. Anyway, that's the game. Yeah.
So, you invested in the fossil group last semester?
Yeah.
Last semester, last quarter. And quantitatively, financials look great. I was curious, qualitatively, what you think their competitive advantage is.
Well, I'm leaning on my colleagues there. When it comes to retail and fashion, I'm not your guy. The analyst who has done the work on that did a lot on Coach when it was fading, and value investors are very often buying things from disappointed growth investors. And some story that's fabulous and fast, the company's growing fast, but is valued at way too high a price for us to think about, gets disappointed by a bad quarter or whatever. So Coach was having some trouble coming down, and we're trying to guess, is it permanent? How deep will it go? And so on. He decided that had more trouble than we wanted to bite into at that point. He's also done a lot of work on Richemont and Swatch and some luxury watch jewelry kinds of companies. And the question there, they've been wonderful, strong family businesses over decades. And the question there is, to the extent that people aren't buying $100,000 watches as much because bribery is being cracked down on in China, how temporary is that? And we just figured it was too hard to know for sure. And I think the story with Fossil is that it's broadly diversified among a lot of different products. It's a license, they sell things that are licensed by other name brands, Coors and so on. Broad product line, low-cost producers, a lot of different price points, so you have diversification there. And the other thing is that when their stock has been really weak, management has been very aggressive in buying back shares. I can't remember the number, but I think they may have bought back 20 or 25% of the stock in the last several quarters while it's been down. That doesn't, I don't feel as personally comfortable and tuned into that one as I do with some of the other ones. But that's the basic idea. and I think it's selling at about 10 or 11 times earnings now, if the earnings hold up. I think it's one of those things where if it's still what we always thought it was, it's got room to double. But if it has to bump along, struggling a little for another year or two or three, our downside's covered. That's kind of the risk reward. Yeah.
What are some things that you shy away from or simply just don't understand when it comes to new investment ideas?
Well, we shy away when we don't trust management from an ethical point of view, or don't like their business judgment, their tendencies to stretch too far in acquisitions and that sort of thing, the kinds of things that can get you in permanent trouble. Now, that's not an it's a continuum there. And there's some absolutes, like one of the young guys years ago brought McAndrews and Forbes to me, said, this looks pretty cheap, should I do some work on that? And with Ronald Perlman as the controlling person, I just said, no, we just don't bother. So there's a few absolutes. But on that continuum, the thing that where we do own some companies that I hold my breath about a little bit, and I had one of the managers on there. That's why I had it on the slide, but I didn't slow up on it. Mike Pearson at Valiant. They've grown really rapidly by acquisition. Done a beautiful job. The stock's up from 30 to 250. Now it's fallen back into the high hundreds for the moment. But it's been a great stock for us. But he is just kind of a he enjoys saying to analysts and investors that he goes to all his managers and says, you make your numbers or I'll get somebody who will. And which is great as long as that just means they work harder and they're more creative and whatever. But it runs the danger of having to start cutting corners if you can't make the numbers otherwise. And I think that's maybe where the Enrons of the frauds crop up. People cutting a little corner and figuring they'll make it up, and then they get a little deeper and a little deeper. Volkswagen with its, somebody at the top probably said, get those diesels sold, make inroads in the U.S. or whatever. So I do worry about culture, I guess you'd call it. I used to say we never owned any technology companies because I don't understand it. I can't make the, I don't really know how a disk drive works, or even if this has one anymore. But we do have people, now with 12 people, we do have some that do understand pharma and that do understand. So there's more, we want to stay inside our circle of competence, but we've got a few more circles now, or maybe the circles are a little bigger. You want to make sure, this is sort of embarrassing, but years ago we were buying a lot of cell phone companies, and the idea was there's a lot of these little companies that are going to be consolidated, and it worked out fine. But it was only after owning some for a couple of years that I found out that the cell signal doesn't go from tower to tower to tower. It goes to the tower and then goes to a wire. That kind of gaps in your understanding can get you in trouble. So we don't try to cover everything, but we try to make sure we know what we don't know, and then either avoid the stock because we can't know it, or go find it out. Companies that have an awful lot of leverage, that just don't have a lot of margin of safety, no matter how much upside there is, if you get into a liquidity moment, you're dead. We don't like binary kinds of situations like that, no matter how much the upside looks like. And I think I've learned by hard experience. I got a lot of scars, so I've been doing it. I really started when I was like you say I started when I was 12, but got lots of scars from either dumb mistakes or reasonable actions that didn't turn out very well. And we got a lot of young people who haven't seen as much of that. So they know a lot of things I don't know, but I can remind them about the framework of it all. So I think it's really helpful to have a mixture of talents there. Yep.
In terms of those scars that you were just talking about, can you give us an example of your largest one, maybe, and how you learned from that experience?
Oh, it's much more fun talking about the good ones. It's also bad not to be able to immediately say the only one there ever was. I think in the housing and mortgage bubble this last time around in 06-07, we'd been investing in all different kinds of banks and mortgage companies for a long time, and knew several subprime mortgage companies pretty well, and could see that they were doing more and more volume with riskier and riskier. I mean, the funny thing, I used to, when I first started out, I always thought that bankers were people you had to court and cajole and sweet talk into giving, making a loan to you. And darned if it doesn't turn out that they're selling a product, because they get paid by the loan they make. And so that got out of hand in the mortgage crisis. And it turned out, there's a lot of different parties. The borrowers, many borrowers knew they couldn't handle it. Many lenders knew they couldn't handle it. The people who took the mortgages, bought the mortgages, packaged them together and sold them, resold them as mortgage-backed securities, must have known. There's a lot of people complicit. It's hard to point the fingers. But we thought we understood that was happening, and sold the companies that were directly making subprime mortgages, sold the packagers and the people who were making their profits on selling the CLOs and the CDOs, and sold the mortgage companies like Washington Mutual and some others that had been put together by acquisition and had like 6 or 7 different platforms going on their IT, because they merged together so fast they didn't have time to wreck. And we held on to a couple of companies that we thought had pretty much infinite source of capital, Freddie and Fannie, because they had government backing, and held on to Countrywide, which had been built from scratch and was a low-cost producer, and we thought had good sources. All financial companies need to borrow money and lend money, make a spread, and so the source of the capital is critical. And we thought that we had the stronger players that could take advantage when the inevitable crash came. And historically, prime mortgages that Freddie and Fannie had owned or backed had annual losses of like less than 0.5%. 25, 30, 40 basis points was a normal year. A bad year might be twice that. Well, it turned out to be 700, 800 basis points on good loans. And then the subprimes were, it's just way beyond. It just swamped. It certainly took out the ones we had sold, but it also swamped the ones we owned. And the good side of that was that we finally acknowledged the problem on those in 07 and didn't ride them all the way to the bottom. but we only sold them halfway down, not, instead of all the way down. But, having a story and sticking to it too hard without checking and double checking your assumptions. And I think the summary thing that we talk about when we all get together every week really is how can we be more imaginative about what can go wrong? When you ever hear yourself say, I hope that such and such is going to happen because then it'll be okay, maybe you better not count on it, because they say hope is not a strategy. But kidding yourself, getting in with too fast a kind of a business, whether it's too much leverage or we totally. Everybody has their personal thing they shy away from. I won't buy cigarette stocks, and that has cost our shareholders some. I think because Philip Morris has probably been a pretty good investment over the years. We've not wanted to be involved with payday lending, and there's certain ends of the financial services business that are dealing with people of marginal ability to deal with the credit they're taking, and it's just a fine line between exploitation and helping the unbanked, which you can make a bull case for it too. But those are a couple of things personally. I'm the head of the investment committee at Carleton College, and this October we're going to be besieged by students wanting us to divest our fossil fuel stocks because it's immoral that the extraction and the burning are bad for the environment, and none of us on the board has any argument really with the fact that when you take the top off a mountain to get the coal, or when you burn fossil fuels and have greenhouse gases, the climate's changing and all the rest. But we object to divesting as a tactic or as a strategy, and that's going to be a big fight. I asked somebody here if that was a subject that came up much around here, and they say, well, I don't know, maybe it's because it's Texas. It doesn't seem to come up too much, but I had a client or a prospective client come in one time and asked about socially responsible investing, and I took that to mean liquor, tobacco, firearms, the sin stocks. And she said, no, I mean HMOs. And she said, I'm a nurse, and I see care systematically withheld from patients because they're being covered by a capitated HMO plan. Well, I hate to say it this way, but if you think about any business too hard and watch how it's pursued in both America and the rest of the world, and look at all the people who are trying to make the numbers and so on, you could be pretty discouraged about what you see. So we try to some extent keep the citizen hat separate from the investor hat, but we don't want to wake up. Buffett has I don't think he coined the expression, but he said, don't do anything you wouldn't want to have your mother read about on the front page of the New York Times. The kinds of things that are going to embarrass you about your companies are the kinds that are going to make them bad investments in the first place. So we try to avoid them up front. It is hard to be proud of your whole gallery of CEOs, though. I mean, even a Buffett. I mean, there are little things around the edges that you'd say, I wish he hadn't done that. You know, and possibly it's true of all of us too. But, yeah.
What are some of the most insightful things you learned from Buffett?
Buffett, well, the idea that you're buying a part of a business, not just a theoretical thing, and that, I mean, the whole thing I went through with the business value and the red line and the discount, I mean, he points out, he always says you should read the 2 chapters in The Intelligent Investor, Graham's book. One about Mr. Market. It says Mr. Market is the manic depressive, that's the wrong term nowadays, the bipolar investor, whatever. My wife corrects me, she's a mental health professional. But that Mr. Market will bid you for your stock at way too high a price when he's on a manic phase, and he'll sell it to you way too cheap. And so it's not what the market price is that matters, it's what the value is, and you want to take advantage of the difference. And the other is the margin of safety. And that is just about, you're going to make mistakes, so if you have belt and suspenders, you have a better chance. So if you buy at a deeper discount and it turns out your top line's wrong, maybe you still have positive return. The circle of competence idea, you know, you don't need to, we don't invest in companies based in China or emerging markets. Not that that can't be fine for somebody, but we don't know how to do it well. We don't have feet on the ground, so we don't try. And we don't feel like we have to have all 10 S&P categories represented. You know, for a benchmark, we might only own stocks in 3 or 4 categories. But as long as they're different enough from each other to be diversified, you know, we want to stay in the things we know. He always talks about you know, reputation and making sure you know where the lines are is his image. I think it's a tennis kind of thing, but know where the lines are, the rules, the regulations, the ethical boundaries, and don't even go near the line. And I mean, these are all kind of, you know, that book, Everything I Need to Know I Learned in Kindergarten. I mean, there's a lot of that that Buffett just says so well that it doesn't sound as corny. But and be patient. Compounding is terrific. Another one is he tells a joke that it's almost always a bad idea to marry for money, but it's really stupid if you're already rich. And I think that has to do, my wife doesn't like that joke too much, so I apologize. And it's not about her, but anyway, I mean, the point being, sometimes people take really ridiculous risks, whether it's financially investing, driving too fast, whatever, when the prize is not worth it. And to, you know, just think, I guess. But you know, if you read, there's a lot of books on Buffett, but Roger Lowenstein's biography, I forget what it's called, the American Capitalist, yeah. That's really good if you read that. Or another one that is recent, that Carol Loomis put together. It's really old fortune stories from the last 30 years, but it's things Warren has written, things written about him, and then little commentary. That's a good one. And there's another one. Who is it? Cunningham. Who's the one who did? It's sort of like a dictionary of. I mean, he has it arranged by subject matters. What Warren has to say about 100 subjects. Essays. Thank you. So you already know this stuff. But I think those three are great place. And the great thing about them is you just read them again every year. I mean, I do reread a lot of things about him. Yeah.
There's a lot of young professionals in this room that are probably going to be putting in their job applications and resumes in the not too distant future. Owning your own business, what's probably the most important characteristic you've noted that leads to success for your new employees?
I think the ones that are most fun to work with and that I think end up doing really well are the ones that are just endlessly curious and energetic about finding out new things. And that's kind of from a job point of view in investing, but also ones that are completely willing to do whatever's useful at the time, if that's cleaning up the coffee pot area or something. I mean, doing the things you're not asked to do that are just people are grateful for. That an attitude that where you just know that this person's always going to be doing something like that, and that person's never going to be doing something like that. It makes a big difference. It's hard to put that on a resume. People that have, I mean, again, it's hard to tell in advance. Everybody, learns the right things to say in interviews, or not everybody, but a lot of people do. And you only find out later whether they really have good judgment about applying those things that everybody knows are theoretically right. I don't know if that's helpful, but the curiosity and the energy. I'm a sucker for enthusiasm, and I may over index to that. Might get me in trouble as an employer. I don't know, but yeah.
When you're looking for a sustained competitive advantage in a company, what are some of the key features you look for?
Competitive advantage. Well, again, it varies by industry, I guess. But when you really look back over a long period at the relative competitive positions of, a Sears and a Walmart and a Costco, one keeps winning. And then you kind of reverse engineer that, and it's maybe because they figured out how to be more in control of their inventory, or whatever it is that's company specific. But it's, I guess, evidence that management has figured out their business, or they just execute better. I think reading a lot of business history is very helpful for investing. I mean, even if it's about the railroads 100 years ago, the tricks those guys were playing on each other then are still going on now. And the store, reading about the big store, I think, is about Amazon. You read about that, and you read about Google, and you read about Facebook, and those are the current, sort of supposed ones that are going to inherit the world. And maybe you get a sense about Bezos versus Zuckerberg, personality-wise, and who's likely to self-destruct first, and does Jeff really, even though he could earn $1 gazillion if they let the margins expand, will he? Or I mean, it's so different company by company, but in TransDigm, in their parts business, there's half a dozen other pretty major parts manufacturers, and if you look at their 10 or 20-year history, the margins are just there's differences in margins and success rates that seem to last, and at first it's not clear always why, but and sometimes meeting the management and Ben Graham didn't believe in meeting the management. He said everything's in the numbers, and you might double count if you get enthused about the manager, but we always like to get a sense of whether they're thinking ahead to next quarter, or whether they're watching Wall Street too carefully, or whether they're really thinking per share or gross volume, gross size. Even though that's not moat specific, it's the people, or maybe where the moat comes in. Yeah.
I'm curious about possible tips or counsels you picked up from Buffett's colleague, Charlie Munger. When he comes to town there the first weekend in May, or maybe you leave town then, I don't know.
I did used to leave town. Now that we have a marketing department, they won't let me. Munger's a character, and I don't know him personally. And there's a lot written about him. There's a new book apparently that's either just out or about to come out that sounds as if it is a good collection of Mungerisms. He is, a lot of the themes that he harps on are, having his mental model idea that if you've thought about how the world works or a company works, or he talks about having dozens of them, that where you already have a sense of when you get a certain piece of input, if you can put it into a model to process that you've figured out ahead of time, that it's like a good shortcut, I guess, is the idea. And if that, you have to read about how he describes that, and if it I think it makes sense to me. I could imagine it would not make sense at all as a way of thinking about it. But if it works for you, it might be helpful. But he's also very scornful about human frailties of all kinds, whether it's personal behavior or I said earlier that we're really kind of taking the other side of other people's emotional mistakes with their investments. He elaborates on that a lot. But there was a book that came out a long time ago called Damn Straight that was kind of a biography of his. It's sort of dry, but probably worth reading. And maybe this new one will be better. You might start with the new one. But he's, it's funny. He's like, it's like a vaudeville show, and Warren gives the long answer, and Charlie says nothing to add or whatever. He's getting a little more loquacious now the last several years. And when he used to do his own meeting for Wesco, and now I think he does one he's still involved with a company called Daily Journal, and I think he does a Q&A period for a few hours. As an annual meeting for that one. If it couldn't hurt to, go to one of those and experience it firsthand. Yeah. Back here.
What are your thoughts on the investing in equities versus real estate?
I just think it's two totally different things. I think anything I might have said about a piece of a business with a stock almost all of it would apply. Make sure you understand the value, and in real estate that could be because of what you're going to turn it into, because you're going to fix up an old building, or you're going to build something on raw land, or whether it's something that already has rents. You can think about the present value, the future cash flows. You can be careful about not using too much leverage. I mean, I don't do real estate investing, but I think the thought process would be the same. I mean, the wrinkles are very different. And when I hear a real estate developer talk about the intricacies of the zoning and the air rights and the finagling with the minority partners, I mean, it's endlessly complicated, and I'm sure it's endlessly interesting to them in the way that very few people would care to talk to me for 6 hours about a company. But so I can't help you there, except that common sense, integrity, managing risk taking, all those things are got to be the same. Behind.
So Warren Buffett said that one of his biggest mistakes was an error of omission, not buying enough Walmart. So one of the ways of getting around that would be the index. And it's a couple of different questions. Is should everybody invest their own money? Is the first question. And second, does index have a place even in your portfolio?
Well, should everybody invest their own money? I would say no. I'd probably say most people shouldn't invest their own money. And it depends on what you're after in investing your own money. I mean, I think one thing that gets in the way of individual success and endowment management success, I mean, I see it on in my own board, is losing track of what you're really trying to accomplish. And as much as we say when we get together at Carleton, we say we know we need to get, we got to have 4% growth to cover the increase in the spending. We got to have another so much for inflation. We got to have another 2 for this. We want to earn 9, whatever. As soon as Harvard or Yale does better than that number, we think, oh, we got to, we feel bad then. And well, if we were really, when 30-year treasuries in 1980 or 81 were 14%, and you could buy a zero coupon, 30-year, 14%, government guaranteed, reinvest at 14 because that's the way zero coupons work. Nobody did that with their pension fund or their endowment that was required to earn 8. Why not? And it's because they can't bear to be left behind if somebody else is doing better. Maybe it'll be 15 next year or whatever. So I think most people are not very. I mean, it's not that they aren't theoretically capable, but they don't. I mean, it's a full-time job. And you can't just drop in and drop out and do it when it's fun and play it like a video game at TD Ameritrade or something. Now finding somebody that, it's funny, we work a lot, more and more of the shareholders for our funds come via investment advisors. And so and that's why I get that dig in about we can make you, if we've made you 2.5% a year for 30 years, the advisor's in position to save you 5 or 6% a year by having you not do something stupid to yourself. So you can at least get that 4 to 6% back by indexing and not flipping back and forth. I mean, Warren has said that his instructions for his widow, when the time comes, is 10% in cash for spending and 90% in the S&P index fund. Low fees and avoiding the emotional mistakes. So I would say that and all the active managers in the aggregate are going to underperform the index by the amount of their extra fees. It's just arithmetic because they are the market. So not doing it yourself is probably the right thing for most people. Doing it with an index fund is probably better than most of the alternatives. And then if you happen to be arrogant enough to think you're the rare active manager, it's a beautiful business. It's a lot of fun. You get overpaid to do your hobby, and I mean it's a good. I highly recommend it. It just may not be. It can't be right for everybody. Yeah.
Hi, Ms. White. Thanks for being here. You own Discovery and 21st Century Fox, and the media companies have sold off in the recent past. So, of all the media companies, what's attracting you to Discovery and Fox? Why not CBS, Time Warner, and Viacom? What are some of the concerns about Discovery and Fox, and what do you think the sellers are missing?
Okay, well, each of those companies is slightly different. We have history with Discovery because we originally got shares in it a long time ago when it had origins in the Liberty mishmash spaghetti slide up there, and it's still 1/3 owned by their old partner Newhouse. So we've known the company really. John Malone has a lot of influence there, and I put a automatic premium on that. So it doesn't mean it's good enough, but it's valuable. With Fox, that's a new one to me. It's less new to some of the other guys, but they're probably in a little better position because of they over-index to sports, live sports, which is of more value to the cable operators, and they just sold they sold some satellite properties for I think they have like $9 billion in cash, which they keep promising to do something smart with. So those two were of interest, and we bought them both recently after the sort of panic over maybe the cable bundle is crumbling. I mean, that fear comes up periodically, and it's getting more and more evidence about it. We always preferred cable to satellite because at least cable had the broadband that you would use if you were a cord cutter from the video. Time Warner has HBO and has some other good properties, but I don't know them. We owned them 25 years ago. I knew them pretty well then, but I have heard informed people say that they have some competitive issues on a lot of the outlets for their properties, but I can't really speak to it very well. Viacom has had the worst experience of declining ratings and being dropped by cable systems, and they may be a buy now that they're down from 80 to 40 and selling at 10 times earnings just because it's gotten so cheap. I just went on the board of Cable One, which is the cable company that was owned by the Washington Post, and after they sold the paper, they now have spun out the cable company. It's the first time I've gone on a cable on any public board, and I'd gotten to know Don Graham over time, and he asked me to do that, and I thought it'd be really educational. So I'm hearing on the inside, Tom Might, who runs Cable One, has had he's been early in predicting that video was going to be less and less profitable for cable operators. They dropped Viacom last year. And now other cable companies are saying, well, yeah, maybe video isn't as lucrative as we thought, but we can make up for it on broadband. Now, how will, Fox also has TV. I mean, it's endlessly complicated, but I think the summary would be that we thought that the advertised panicky problem is not as bad as it looked. The pace of decline of subscriber fees, actually they're still going up at Discovery. Discovery also has half its business abroad, so it doesn't have, and it's a lot different economics over there. And we, of course, have Liberty Global in Europe that can give us some look into what's happening with Discovery over there. And Discovery is also just bought Eurosports. They're trying to create an ESPN kind of a thing in the rest of the world. There's a bunch of positives, but it's still, something I said early on about value investors often buying from disappointed growth investors. There's always been a tug of war between the content companies and the distributors, and it may be shifting back a little bit towards distribution. And how much of that is temporary? How much of it's permanent? How fast will it happen? That's why we've taken 1 or 2% positions in those things, not 5 and 10. But that is I love that arena because it's colorful people. I've been following it for 25 years. I think we have pretty good sources of insight into what's real and what isn't. But it's still, there's no sure thing about it. But those are the two we picked for now, and then we might sell them tomorrow, but I don't think so. But I don't feel like those are the permanent answers at all. There's no permanent answer in any of that world. Yeah.
Is your media pretty much segmented toward television? Is it because of Malone you have so much respect for him?
I think I have to stop and think about what else we might do instead. I mean, movies tend to be hit-driven, and so we've rarely, if ever, owned a movie studio, although some of our companies have interests in production. Radio has followed newspapers down pretty far and isn't so interesting, although we have satellite radio through Sirius, which is owned by Liberty Media. We used to have DirecTV, and we liked the fact that they were generating free cash and spending all of it on shrinking the market cap, so the per share value kept going up, but it still did not have broadband and had a terminal value problem. So we're really glad to have AT&T take that off our hands, and we've not really been tempted by Dish, which of course also has a lot of cellular spectrum that may be worth more than the stock price. But TV just seems to be the producers, the cable companies, it's all about video, it seems, these days. And I'm not sure if I'm missing a category that you're thinking about. But it's not just a Malone thing. But once you get into cable and programming and distribution and bundles and all that kind of stuff, everything leads you to Malone because he's found his way. He's got his tentacles everywhere in that world. Now we have a new player coming in from France who I've read idolizes Malone, and it's like his hero, and he's trying to be John Malone. Altice is coming in and paying what seemed like pretty ridiculous prices for Suddenlink and now Cablevision. So there's always new people, and having free money available for everybody until maybe soon has made it all, stirred up the mix and sped it all up. It's a fun area. But the part that I think the underlying thing that we love is subscription business builds on itself. You know what you have on January 1st every year, and you're going to get a little bit more. You create something once and you sell it millions of times. That's good. And it doesn't, mostly it's kind of glacial change. So that's why we've had cable since back in the late 80s or mid 80s. I'd love to own Comcast, but a little expensive. We own Charter indirectly through two other things, Liberty Broadband and Liberty Ventures. But Charter's now trying to take over Time Warner Cable and Newhouse or Bright House. Actually, going back to the spaghetti chart, I think there's a lot of people who've sort of given up on trying to figure out how all the liberties work. And maybe that gives us a little advantage just because we're willing to take the trouble. You guys wearing out? No. Okay. Yeah.
You've had a very successful career over the past 45 years, both for yourself and for your clients. However, you've stated in the past that a lot of your success came from simply getting away with bad ideas. Do you think that if you started your career today, you'd be as successful? And how do you define success?
I didn't know. I didn't remember I'd said that publicly. But it's true. No, one night there's a group of us that get together once a year. Allen and Company gets us together out in Wyoming, and it's Bill Miller and Chris Davis, and it's a list of you know all the names. It's like 8 of us, and we bring in a CEO in the afternoon, have drinks, dinner, keep them up as late as we can. Meet again the next morning, just around the breakfast table, and then he leaves and another one comes, and we do that for 4 days. It's one of my very favorite things. But one night, sitting around with two different scenes, the same table. One was we got talking about some stock that was misbehaving badly. And and we all owned it, or had owned it. And one guy said, "Well, I thought you knew what you were doing." And that guy said, "Well, I thought he knew what he was doing." And I thought he knew what he was doing. And it was only half a joke, because we do watch each other. But the other scene was, I tried to get him talking about how much we all have these long records, and how much of that record was bad ideas you got away with. And they did not want to talk about that. It was very interesting. But I think what prompted me to think about it was, we got caught in the mortgage thing because all the traditional measurements of how bad something can be just got blown out completely in 08 and 09. But got me thinking back that we've made a lot of profits going back in the 70s, 80s, 90s, and into the 2000s from taking the other side of people's reaction to the Fed. And what they're doing now is just, it's off the charts. 0 for 7 years it's just totally different than anything that's ever happened before. And you could, you might argue that it's a really bad thing or not. But in the old days, the economy would start, inflation would tick up, and the economy would look like it was overheating. And they talked about, Burns, I think, was one of the Fed directors that talked about taking away the punch bowl from the party when it gets, every time the Fed would raise rates a little bit, people would panic, and they all sell their financial stocks, their banks, and they would, I'm oversimplifying, but not much, that, they'd all be selling at 10 times earnings. They go to 5 times earnings. We could buy them at 5 times earnings. 6 months later or 9 months later, they stopped raising rates. everybody relaxed and they went back from 5 times to 10 times. So I mean, it was just really easy money with very little, seemingly very little downside. And what we realized with the recent unpleasantness was that those banks were over-earning, over the years, and that they really were making very weak underwriting decisions about who they'd lend to, and they were taking on too much leverage of their own, stretching to make more loans, but they always got away with it because the house prices always went up. Because they'd have bad loans, and then the people that took out those bad loans and that were in trouble could sell the house at a profit and pay off the loan, or if they foreclosed the real estate, the REO, they could sell and get whole. And so they never paid a penalty for their bad behavior or their poor business practice until they got caught then. And so if we made, out of our 13.5% a year forever, I don't know whether it was 0.5% or 2% or, some amount of that outperformance came from that easy money trade that we did maybe 4 or 5 times over the period. But I consider that a bad idea that we got away with. And there's probably plenty more. I mean, when when you recognize, Valiant maybe is another one. I mean, so far we've mostly gotten away with it, although it's come down from 250 to 170 because there's been threats of looking harder at their practices of raising prices and that sort of thing. But I've had qualms about the manager pushing too hard, and I've had qualms that the magic of putting 2 companies together, neither of which we particularly wanted to own before, now makes them both go up. That's a sign as a symptom of an overheated speculative market. Now they've gotten away with it and they've done a good job of integrating and they have organic growth, and I think it's going to be okay, but I've cut back the position. I kept cutting it back and I've cut it back further. I just worry about it. And yet you can't wait for everything to be perfect and to only buy Berkshire Hathaway's, at half price, because you'll never have a portfolio. There's a fine line, and that's another thing that's been interesting about having, the younger guys in the company, and now working with my son Drew, and I do manage Hickory fund together. And there'll be 2 situations that seem the same on the surface, valuation, type of company, whatever, and I'll be really comfortable with one and not the other. And I have a lot of trouble sometimes actually articulating why that is. And it's good to be pressed on why. But there is, it's some of those scars that it affects the, I don't know if it's subconscious or unconscious or whatever. I mean, it's, I still haven't figured it out after 45 years, I guess is the answer. But it's interesting that when you look at, in different market cycles, we'll feel sort of envious of XYZ manager that has outperformed recently because they have just the highest quality companies and no leverage or whatever. And then in a different era, it'll be another XYZ manager that has a totally, we do similar things, but they do a pure version of a part of it. And so it's tempting to say, well, let's just do only those, but it doesn't really work that way. Yeah.
So Wally, you've been operating your firm for decades. You obviously are at a point in your life where you don't have to work. You work because you like to.
Yeah.
You and Buffett one day will no longer be here.
Yeah.
What would put a smile on your face on your last day in terms of how your office and your team would think back upon the legacy you left behind? And add your family in there too.
I would like for people to think we did it a little better than most or anybody. Why say most? Did it better, did it the right way, where we could just be proud of what we did and what we didn't do. And that we, maybe aside from making clients a lot of money, maybe helped them be comfortable with their money. Because one thing in dealing with clients I found is that some of them are just chronically anxious and never learn to relax, or they're always envious, or what, so maybe, and what's most satisfying when clients come in, old clients that have been around for a long, long time, saying, the quality of my life has been better because of the investments here. That's good. And then the others, to have made, tons of profits and done something good with them. And I'm finding that I'm spending, a little more time on trying to figure out how in the world to, it's easy a college can absorb any amount of money, big checks, but, and Carlton's happy to do that. But how do you, but how do you have little agencies that do great things, it's usually one person that drives it. How do you reproduce that person, and how do you scale their work? And I would like somehow for the legacy to include having figured out how to do that well. Buffett has given away $50 billion, but I don't think he's very interested in the giving away. That's why he farmed it out to somebody he thought was scaled to do it, Gates. But his daughter's down in the trenches doing some pretty interesting things. I'm on her board, and we've done some things together. But it's hard. It's much harder figuring out how to productively give it away. Much harder. So I'd like that to somehow a good result in that arena to be part of it, I think. Yeah.
So just piggybacking off of what Dave said, you do it because you can retire, but you do it because you love it. So what drives your passion for this?
Well, I don't love it every day, but on balance, I love it. I think it's the fact that you can never totally figure it out, and there's it's a treasure hunt for the next great investment idea, not only to find it, but to do it bigger this time. Not to have the error of omission from having done it in too timid a way, but everything's related. All the news, all the world events, all the stuff you see in traveling, the way it all kind of filters back to the investment question to me. And so, I can be my wife likes to travel more than I do, and I'm happy, I do my, we've gotten to an arrangement of how much there'll be, but you're always learning something new, and it's, I'm a total introvert, so I've not taken advantage of the all the various contacts and people in the business and people in businesses that I could hang out with more. I mean, a lot of my counterparts spend loads of time. Gordy Crawford was the amazing media analyst for Capital Guardian. And he spent a good part of his social life was, playing tennis with Sumner Redstone and hanging out with the Disney people, and that's that's not me, but that was really good for their understanding of how the businesses worked. But I don't know. You can only. I love to play golf, but you can only, you only play so much, and I love to read, and it just seems that I end up reading business-related things. Are broad, a pretty broad array of things can be business-related. I don't know. My wife thought maybe we would retire and go, just do nothing but traveling. But what happens when we travel is we go to a very nice place, because she likes very nice places, and we sit on the patio overlooking, whatever, and read. So I'm happy sitting by the fire and doing it at home, and then going to the office. And I like the people I work with, and working with Drew is fun, in a little different way, and it gives me a little cover with her too. And all my, all three of my kids live in town. 6 grandkids are there, so we can get we like different levels of doses of family time, but we can both have the right dose, and I don't know, it just works for me. And and it allows for going to Scotland. Paying for going to Scotland to play golf, and a few other things. Like I say, you get overpaid to do your hobby. How can you fight that? Yeah.
How do you calculate how much of each company you want to own?
Well, there's 2 parts to that. One is how much of the whole company you dare own, because when we got a lot of assets in the late '90s, early 2000s, and we were focused on a lot of pretty small companies, and we ended up owning 10% of several of them and 20% of some, and that turned out to be a problem if we wanted to change our mind. So we're pretty hesitant to get much over 5% of a company. We'll go a little higher if it's a special case, but you probably meant position size in the portfolio, and I think I said earlier that 5% is kind of a normal full position, but we're happy to go further if it's really cheap and really safe. We think safe. In today's world, in the Partners 3 fund that I manage by myself, we have probably 3 stocks that are 7-8% positions, and yet it is only 65% net invested. So it's pretty concentrated in that handful. But really, part of it's a function of how many great ideas you have. If you only have 5 or 6 great ideas, you might as well put the whole portfolio in them, or pretty close to it. If you got tons of them, why not diversify so that when you're inevitably wrong, it won't hurt as much. And back in, it was '91, I think, when there's commercial real estate collapse that actually sank Bank of New England and some other major banks. They went out of business. It was really pretty traumatic. In its own way, it was like 08 and 09. And banks just sold at dirt cheap levels if you were confident that you knew what was in their loan book. And there's really no way without inside information, I think even the bankers weren't so sure, but without inside information, we couldn't know. So the idea was, if you could find one that's probably okay and it survives, it'll double or triple. But we implemented that with 12 different banks, just in case. So in that case, it was one idea that might have been 15% of the portfolio, but it was 12 stocks. So I guess you want as much as you can buy of your favorites without being too greedy. And I think in some cases that's why we only have 7 or 8% of those three. It just would be kind of greedy because things go wrong. Nothing's perfect. Yeah.
So due to your interest in golf, what's the biggest surprise decision you ever made on the golf course?
The biggest decision I made on the golf course? Biggest surprise. Investment-wise, yeah. Well, there was another bad stock we had in 07 that I forgot to mention. It was AIG. And the problem with AIG was they had written insurance on mortgage-backed instruments, and they had grossly undercharged for the premium. I mean, it's okay. You can insure anything, even something that's sure to lose, as long as the premium's right. They were grossly under because they just didn't understand what they had, and they ended up going bankrupt. Well, the government had to bail them out for 85% of the thing. But I was on the golf course, and I got a phone call from the woman who's the chair of our mutual fund board. And I dumbly answered it. It was really a mistake to answer that. I mean, I should talk to her, but I should never take a phone call on the golf course, but because it's not good. Anyway, so she said, "Are you sure about AIG?" And she didn't know anything, but she heard the scary, there were suggestions that might be in trouble that turned out to be right. But it was that listening to myself answer her, it didn't ring true. I mean, not I was lying. It's just that my story that I had told myself all this time didn't convince me as much as it did before. And that was one big step towards getting out in the 20s instead of at 2. So I don't know if that qualifies. Another a very close version of that was sitting in the dentist chair. And my dentist with his sharp instruments in my mouth, who was a client, was saying, "Are you sure about that Countrywide?" And that was October of 07. And it was in the stock was in the teens. We sold, and the same thing. I didn't like my answer, and we sold it. I have one more completely off the point story that reminded me of. I also had my internist in his office were clients, and the woman, I went in for my annual physical, and the woman put the elastic thing on there, and she's sticking the needle in there to draw blood, and she says, "So how's our fund doing?" And I was kind of like, it's doing really well. But anyway, you got to keep your universes separated, I think. Yeah.
You touched on it a little bit earlier, but how much does your team pay attention to what other professional investors are doing? And do you find it is more of a distraction, or have you ended up investing in some companies because of that? And how much are they looking at that, on any given day when they're researching versus just researching themselves?
I think a lot of it goes on, and I think there's good and bad to it. As I've gotten to know some of these people, I've paid less attention. And I mean, they're smart people, but they're not magic, and I'm not magic, and I'm sure they have said the same thing about me. Like that day we were pointing around I thought you knew what you were doing. But it is, I think our guys do spend a fair amount of time looking at the 13F filings every quarter, and we read interviews with people that we have some respect for that'll, explain why they own a certain stock. I think the old Outstanding Investor Digest was a pretty good version of that. Henry Emerson wrote it. Unfortunately, he didn't know how to edit himself, so he'd have 60 pages that should have been 10. But and then today there's Value Investor Insight that Whitney Tilson and John Hines do. It's what Henry should have done, and it'll be two investment teams talking about their favorite half a dozen stocks. And I think we all read versions of that, and we never swallow them whole, but sometimes it gives you an idea of something else to look at when you're just hunting. And also, we'll see somebody bought something, and we'll discuss, like what do they see in that, and do they have that right? And it's not a very long list of people, but when we see what Buffett does, it's of interest. And I've gotten to know Todd Combs pretty well. He's one of the two guys that Buffett hired, and he doesn't tell secrets, but it's fun talking to him about what's going on at the companies that it's public knowledge that he owns, and I have a much different appreciation for the resources that you have if you invest at Berkshire Hathaway, because you can call the CEO of any of 100 industries that's already in your company, and find out how things are going. No secrets, it's like, jewelry sales are a little punk, carrying less oil but more coal, it's a huge advantage, and I don't begrudge it, but you do have to understand in the big competitive universe of who you're investing against, some have advantages that you need to respect. But it also can be a distraction, and some wild goose chases, and each of us has some real clunkers on our 13F. Yeah.
So I have two questions. It's obvious that we're all value investors because we're talking about the mistakes that we've made, the risks. So the first one, I'm going to talk about the good stuff. When do you sell out of a position? Is it always 100% of what you consider to be fair value? Obviously, those are estimates. Those estimates could be off. So do you move out at 95%? Do you kind of wait if there's momentum to go to 100, 110? Then the second question is more catching a falling knife.
Yeah.
you know, as the red line and the green line.
Right. Well, yeah. On the first one, you described the good side of selling, and that's when things get so valuable that they go up so much you have to sell them. There's other times when you just figure out you're wrong. But in the last last couple of years, when the market's been sort of, I think, just inflated across the board, where everything's gone up together and everything seems to us to be, 10 or 20 percentage points higher on price value than we want. I've kept positions longer than I would otherwise have. And I've let TransDigm and MasterCard and a couple of others like that get over 100. That's not part of the game plan, but it's, already having 20 or 30% cash and no great ideas to trade them to, just to go from something that's on paper a 100-cent dollar to an 80-cent dollar that I'm not near as confident about. I've been willing to keep some of those other ones. Now, on the other hand, Martin Marietta, when the Martin Marietta material, the rocks and gravel get to 107%, has to go. I mean, it's just, now it might still be wrong, it might go higher, but risk reward just not good. And I think some of the younger guys, we have a research fund, so that there's, of the 12 of us, 2 are bond people, 2 are traders, 4 of us manage the main funds, and the other 4 analysts have a research fund they each manage a quarter of. And it's a public fund, and it's actually done pretty well. But when they make a trade in their sleeve of the fund, they have to, do a little write-up on why. And I always get a little queasy when one of them says, I sold an 86-cent dollar to buy a 79-cent dollar, and it's like, maybe a false precision in there. When some energy companies and some other things that have real question marks about them have fallen to 60 or 50 cents on our matrix, I've not bought them, because that wasn't a deep enough discount, because I wasn't, and I don't know whether I wasn't really believing the V, or, it's not mechanical. And there might be 2 90-cent dollars, and I'd sell one, I might even buy more of another one. Because it's that value number, that red line is, they make a model, and it's, we think revenues will do this, the margins will do that, the free cash flow at the bottom. You put a terminal multiple, I assume you all do DCF kinds of things, and you put a terminal multiple on that's supposed to be an approximation of, to cover what would have happened in the next 10 years. Well, that terminal, one guy will use a 12 terminal multiple, and somebody else use a 15, because they have different ideas about how fast the growth will slow down. And I can't swallow that whole. I totally agree with the concept that the business value is the present value of the future cash flows. It's just that I don't really believe in the estimates that much. And so I think each of us would use that red line number a little differently. I mean, it's handy to have another line that's 70% of it, just for illustration purposes, and that's approximately what we do, but not precisely. What was the other? The falling knife. Yeah, plenty of those. That's where a lot of the scars come from, and I'd like to think that I'm getting smarter about recognizing them, but that that place of buying something from the disappointed growth guy, is, it's such an intangible thing. Is the story over? Is the story he liked over? Or is it just temporarily disappointment? And, is Discovery gonna, if they're losing 2% of their paid subscribers, is that gonna go to 4 and 7 and be a falling knife? Or is it just gonna be 2, 2, 2, 2.5, 2.5? I think in the past, there have been more times when I thought the value was 100, bought it at 60. Well, turns out things changed and the value was really 70, but now the stock's 40. Well, it's still a steep discount. Hold it, maybe buy more. About the time that value ticks down more than a couple of times, I think I'm more hesitant to believe that it's not a chronic, permanent, terminal thing. But it's all, sort of by definition, especially in an expensive market, everything that we could conceivably buy in that kind of market has something wrong, or potentially wrong, and you just got to make that judgment about whether it's a temporary wrong or the beginning of a permanent wrong. I remember Chris Davis was on the board of Washington Post, still is, but when they still had the newspaper, and I remember sitting in his living room, and there was a guy from the Post there, and they were reminiscing about the previous summer, so it must have been maybe, I can't remember, it's in the 06, 7, 8 range, and they were reminiscing about how the classifieds had been trending down for a long time, but how they suddenly went off a cliff, just like in a matter of 2 or 3 months. And Craigslist had been there and all the various online things that had been chipping away at it, but something sort of congealed between the competition and the economy or whatever, it was off a cliff. And I don't know, we're trying to be imaginative about what the next one of those might be, but it's still, is Valiant a falling knife? It's down from 250 to 170, but it's still up from 30, and they, are probably going to earn $12 or $13, $14 a share. They have organic growth. Hillary Clinton said we want to clamp down on drug prices, and that's not something that is going to happen for at least a year or two, if ever. And if it happened, it might not happen much to them, but it's always that doubt. What I aspire to is not having anything that I wake up at 4 in the morning and wonder about. And I almost never have waked up in the middle of the night and worried about a stock. But in the fall of 2008 and into early 2009, there was probably a half a dozen times, and it was almost like the alarm clock was on, because it seemed like it was 4 o'clock every time. And I'd wake up and I'd think, wow, Redwood Trust is probably okay, but I wonder about that. And that's the kind of world, and they were fine. But that's the kind of world that was, and I did not like that. And so that's, I guess maybe you build your own margin of safety fat enough to suit your temperament on that. Some people have a lot more tolerance for trouble. And we had, some people have the attitude that it's okay if some of your stocks go to zero. It's they just do like the statistics textbook says. You look at the expected value. As long as the expected value is high enough of your portfolio, it's okay if you got a couple of zeros, as long as they all average. Well, I'm not too comfortable with that, but it's a different. I mean, that's a style of investing that can be just fine. I mean, venture capital is the extreme case of that. Every once in a while, you get the Google that carries you through the 20 busts, but a lot of scars on the falling knife.
Folks, let's give Wally a big round.
Thank you. Thank you. This is fun. I like this.
Wally, we have a great value investing gift, party gift, very limited.
That means you didn't. Yeah. Okay. I know what a value gift is. Yeah.
You can show this to your friend Mr. Buffett. He does not have one of these.
Perfect.
But, as a rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Famous quote by Mr. Buffett. You are now an honorary member of Bulldog Investment Company, and also in honor of you taking time away from your family and your schedule.
Thank you.
Next semester, the top performing students in our program will receive the Wally Weitz Scholarship. Thank you so much for being here.
Thanks a lot. Appreciate it.
Can we get a quick picture?
Sure.
Thank you, everybody. Enjoy homecoming, and for my students and even some of the alums, let's get a quick picture with Wally before he has to grab a plane and get out of here.
Students at TLU engage in high-impact educational experiences that include civic engagement, aesthetic expression, critical thinking, and a focus on intercultural knowledge in a community that welcomes the interplay of faith and reason.